Hello and welcome. My name is Camilla Cox. I'm a Senior Corporate Affairs Advisor here at Wilson Asset Management, and today I'll be chatting large caps with Anna and Hayley from the WAM Leaders team. Anna, we'll start with you. QBE obviously just came out with that solid quarterly result, so where do they sit with you?
So QBE is a global general insurer. It's very easy to discard it as an investor as being too big and too complex. It operates across every continent and every business line. But management's done a really good job at simplifying the business, optimizing the business, and really turning things around. But the journey is not over yet, and they haven't quite conquered the North America strategy. And we think this is the next leg of growth for QBE. We're very confident in management's ability. The market environment remains very conducive to this growth. And overall, you're able to pick it up at the moment at quite a discounted valuation. So we see the earnings growth, we see the valuation, and for us it just seems like a sensible core holding in the fund.
Hayley, the China wine tariff was recently removed, so what does that mean for Treasury wines?
Yeah, that's right. So the wine tariff that was imposed on Australian wine going into China was recently lifted, and that's a very great news for companies like Treasury Wine Estates. Treasury Wine Estates is the largest listed global beverage company, and they are in Australia's most iconic wine brand like Penfolds. So that'll allow the company to re-enter into China, which used to be the company's largest end market. Re-entering into China will be a multi-year journey, but what it does a bit more near term is that it creates a bit of a demand and supply imbalance, which means it'll allow the company to take further price rises and also expand their margins. And also just touching on the US, Treasury Wine recently acquired a premium wine company called Dow Vineyards that also allows the company to pivot more towards the luxury wine, which has sort of proven to be a lot more resilient through the economic cycle. So putting that all together, we think the valuation of 18 times, which is 3 to 4 turns below the historical multiples, is quite a deep discount, and it should start to see some re-rating as the market gains a bit of confidence around the recently acquired Dow business as well as the re-entrance into the Chinese market. So we like Treasury Wine, and it is a core holding in our portfolio.
Fantastic. Anna, at our recent roadshows, the team were promoting Telstra as an AI beneficiary. What's their outlook for the near term now?
You're right. So Telstra is one of those less thought of AI beneficiaries. And the reason for that is connectivity. There's no point in having the data and having the artificial intelligence if you don't have the infrastructure to connect data centres with the likes of ourselves and businesses. But that's not really what I wanted to focus on today. When we think about Telstra, it did take a bit of a hit in February, and that's really because its enterprise division has been doing quite poorly. In hindsight, that makes sense. The economic environment is tougher, and this is really now an opportunity for Telstra to relook at that entire business division and cut costs. So we're looking forward to an update on that. But with Telstra, you are at risk of not seeing the forest for the trees, and 70% of their earnings come from the mobile division. And the mobile division is in the best place it's been in years. Prices are increasing, subscribers are increasing, and the industry is rational. So we see the current share price as an opportunity to enter one of the best businesses in Australia at a discount.
Hayley, Woolworths are always in the news lately. They're having a bit of a tough time. Are you positive on them?
Yes, we are. So Woolies is a company that needs little introduction. They're the largest supermarkets in Australia, and they also own discount department store Big W and also supermarkets in New Zealand as well. So like you said, they've been going through some tough times from regulatory environments to cost inflation and also some operational hiccups as well. But fundamentally, we think the underlying business is very solid. Woolies have invested in their tech and media capabilities well ahead of time, which we think will set them apart in the years to come. Just thinking about the share price, we think it'll continue to be volatile in the next couple of months. But when we think about the second half of this calendar year, we think the company will be able to demonstrate the fact that they've regained the sales momentum and also market share. And we've sort of started to see consumers starting to cook and eat more at home, which is a lot more household budget-friendly option as opposed to dining out. So that's also positive for the supermarket industry as well. So at $30 share price and 18 times PE, we think this is a very rare opportunity where you can pick up a quality company at a deep discount to what's considered a fair value.
Anna, what role does Stockland have to play in Australia's housing crisis?
So Stockland is a real estate trust listed here in Australia, and they have a passive business where they collect rent on commercial properties such as logistics, retail, workplace, but they are best known for their active business, and that is their residential business. So after completing the Lend-Lease Communities purchase, they will have over 100,000 lots in their pipeline, majority of which will be activated in the coming years. And this makes them one of the largest landholders in Australia. So they certainly are a very big voice when it comes to reform around our housing market. But there is no simple solution. It requires a coordinated effort from all levels of government, from industry bodies, from corporates. But when you zoom out, there are very strong tailwinds for Stockland. Supply is limited and demand is strong, and it is growing. So any policy action will have a benefit for Stockland.
Hayley, can you tell us a bit more about WiseTech Global?
Yeah, so WiseTech is the largest global leader in the logistics software. Their software capabilities span across freight forwarding, customs, compliance, as well as landside logistics and warehousing. And these softwares have sort of proven to provide their freight forwarders and third-party logistic provider customers with efficiency gains as well as critical visibility to their businesses. WiseTech is definitely not cheap, but we think there are multiple growth drivers that still make WiseTech very attractive for us. So that includes things like a very strong pricing power given their unique software platform. And they're still quite under-penetrated with their existing customers, and also have a significant runway of addressable market in the broader logistics space, which is going through a bit of a digital transformation. So putting that all together, we think WiseTech can deliver sustained 30% plus revenue growth and also return back to 50% EBITDA margin in the medium term.
Thank you. And CSL is a shareholder favourite. Is it still a favourite for the team?
It is still a favourite for the WAM Leaders Fund. So CSL is a global biopharma company. They have three main divisions, being CSL Behring, their plasma division, CSL Seqirus, their vaccine division, and CSL Vifor, which is their iron franchise, which has most recently been acquired. It's actually a very similar story to Telstra, in that there are a lot of tailwinds for the business, but there have been some more recent hiccups. One of them being CSL Vifor. It hasn't performed to expectations. And secondly, CSL 112 did not meet its primary endpoint in its clinical trial, which was a disappointment for both investors and the medical community alike. But when we zoom out again, we look at CSL Behring, that is generating 70% of revenue for CSL. And when we think about businesses, we think about the levers for growth, and they have more levers than we can count. They're accelerating their revenue growth, they're improving their margin profile, and this is really just a company that is going to continually compound double-digit earnings growth, and you're picking it up at a good price.
Hayley, Aurora recently had an investor day. Did they share any good news with the market?
Yeah, so Aurora, just firstly, they manufacture cans and glass packagings in Australia, and they also do total packaging solutions in the US. And they also own Saverglass through a recent acquisition, which manufactures high-end glass bottles for premium spirits and wine industry. So yes, they've been going through a bit of a challenging time recently, mainly due to global destocking of beverage industry, which has been a bit more pronounced than it was first anticipated. But as you said, we did go and visit their assets in France through the Investor Day Aurora held for Saverglass, and we came away with a lot more confidence that their assets are high quality and very well invested in, and also the longer term opportunities in the business. So at the current share price and 18 times PE, we think the medium term opportunities are not appropriately captured in, and we continue to like Aurora.
Great, thank you so much for your time, Anna and Hayley, and thank you for watching.